Good afternoon, and thank you very much for the invitation. I think 4 weeks ago, we saw the destruction from Hurricane Matthew in the Caribbean. And I think this is a strong reminder to us on the urgency to act, and also on the issue that insurance cannot prevent extreme weather events from happening, and insurance will only cover the economic losses and can mitigate the impacts to livelihoods. But the overall challenge is to achieve the mitigation objectives to avoid a further increase of number and strength of extreme weather events. And what we're talking today is a dimension how to mitigate the problem, but will not solve the mitigation challenges. We have been working with MCII on the study they're presenting today. I would like to give you a little bit of context on the Insure Resilience Initiative. As probably a lot of you know, G7 leaders in 2015 under German presidency pledged that an additional 400 million poor and climate vulnerable people should be covered by insurance schemes by 2020. So this is the objective the G7 set at the G7 summit in Germany in Elmau last year. I'm very happy to report that our Chancellor herself is a great fan of climate risk insurance, because the instrument changes the paradigm from helping through voluntary contributions to a right of coverage of people which suffer from extreme weather events. And this helped us also among the G7 to move forward to a rapid action package in the COP21 in Paris. G7 pledged an additional 420 million of public funds, and our calculations say that we probably will be able to achieve a coverage of 180 million through this support. 420 million, 180 million people, and this will be for indirect schemes where sovereign states have insurance schemes, and direct schemes where individuals will be covered. Some elements of progress. We have been working as G7 countries with the African risk capacity to expand the coverage to further countries. We're working with African risk capacity also to introduce new insurance schemes, such as coverage of floods and tropical cyclones, and probably will increase also the capital base of African risk capacity to provide for that. I'm very happy that in 2016, the Pacific Catastrophe Risk Financing Initiative, through support from the UK and Germany, got off the ground. The new climate insurance facility now offers risk coverage against tropical cyclones, and since November 1st, the first 5 insured countries, which are Vanuatu, Tonga, the Marshall Islands, Samoa, and Cook Islands, are insured by PCRAFI, and the G7 provided a contribution of $35 million to make that happen. As well, we see progress in Central America and the Caribbean through the CRIF facility, and here also several partners from the G7 group, such as the US, Canada, UK, European Commission, and Germany, made contributions in order to start the initiative. And talking about CRIF, I think it's good news that we saw that the mechanism really works with the cyclone with the Hurricane Matthew earlier in October, where after this hurricane, about $30 million were made as payouts for 4 countries which were affected by the hurricane. So this is something where we can say the mechanism works, and it's a fast-working mechanism because it took less than 2 weeks to make the payouts. What is the purpose of the study? We were going to hear in a few minutes. Insure resilience is supposed to focus on poor and vulnerable people, and to help us as G7 in expanding insurance coverage, we asked for input, that we have some guidance on how the mechanisms and solutions to protect the poor and the vulnerable should be tailored to local needs and to maximize the impact. This will help us to design also a monitoring system for the insurance resilience initiatives, and will allow us to conclude discussions on definitions. What is the understanding of who is poor and vulnerable, and where should the focus of the initiative be? I think the challenge will be to translate this in practical terms. So I'm eager to listen what we can take on board. And this will hopefully then allow us to build climate risk insurance schemes beyond those 3 which I have referred to, which then ensure resilience building as well as insurance to cover the risk of the poor and vulnerable people, and thus contribute to comprehensive climate risk management. And now I hand over back to you, and eager to listen.
Thank you. That was very helpful. Thanks for putting our study again in the perspective on the how it stands on the injury resilience and what contribution it makes. I would now go to our next speaker, Ms. Laura Schäfer. Laura works at the MCII project office and manages the project where we give this advisory role to injury resilience. She is the lead author of the study that we will present to you today, and she also works as policy officer for German Watch and focuses on the international climate policy, specifically on topics like adaptation and loss and damage. So, Laura, we're excited to hear about the study.
Hi, that is working. Thanks a lot, Michael, and warm welcome from my side. It is with us this afternoon, being interested in this important topic. And so what I will do in the coming 10 to 15 minutes is talking about the report that Michael already introduced, and which we produced a short version of for COP in this policy report, available online from today on. And the context in which we wrote the study is, and Michael has already alluded to, is that the relevance of insurance as a tool within comprehensive climate risk management has been recognized by policymakers around the world and practitioners. And now we have the situation that a lot of people, policymakers as well as practitioners, are investing a lot of resources into developing new climate risk insurance projects or supporting ones that have already been rolled out. And the Insure Resilience Initiative is a big player in that game, so to say, and it's unique in its scale and focus on people who are most vulnerable, like the poor and vulnerable. We just heard it. But we have to make sure that initiatives like that actually reach this segment of the population, which is quite challenging. We all know that. But on the other hand, we can learn lessons from insurance projects and schemes that have already been rolled out, and there are many of them. And so what we did in the last year is selecting 18 of those schemes, both direct schemes like the Rural Resilience Initiative in Ethiopia, or indirect schemes like the African Risk Capacity, and looked at 2 questions. Michael, could you? Thanks. And the first question concerns the why. Why should we even bother thinking about that? Why should we be concerned about climate risk insurance? What can it do for poor and vulnerable people? And it's the question, and if yes, how can climate risk insurance contribute to the resilience building process of the most vulnerable? And then the second question, which is more about the how do we do that? How can climate risk insurance effectively reach the poor and vulnerable? What are factors of success and what are challenges? And as Michael already said, our primary goal was to support insurer resilience in that, but the findings can also be applied more broadly and guide other climate risk insurance efforts and the international policy process in realizing insurance as a tool to address climate risks. And so in the coming 10 minutes, I will talk about the findings with regards to those 2 questions. And before I do that, one thing to highlight is that this study and these methods should be treated as points of departure for further research into climate risk insurance for the poor, because the analyzed insurance schemes, those 18 schemes, are relatively new with regards to insurance schemes in Europe that have been there for 100 years. And they are new, and we just have a few impact evaluations that have been carried out. And so it's a really good start, but we need to increase our research efforts in the future to know more about, and in particular to know more about the long-term impacts of insurance. Okay. Starting with the first point, why should we think about that, and why or how can insurance benefit the poor and vulnerable? We looked at resilience because insurer resilience has it in its name, a long-term perspective on increasing the resilience of those people. And we use ODI's 3A's to measure the impact on resilience, which is anticipate, absorb, adapt. And looking through the schemes, we looked at impact evaluations. We talked to people from the schemes. We found that climate risk insurance can contribute for people to build their capacities, like anticipative, absorptive, and adaptive capacities, in 4 ways. And you see that in that graphic. And I will restructure the order a bit to bring a red line into it. Because first, insurance can play a protective role. We see, or we know that when a crisis occurs, the most vulnerable often resort to a variety of coping strategies that on their own might impede their sustainable development and might bring them even further into poverty. They reduce their spendings on health or food, or they take their kids out of school. And now insurance can act as a buffer after an extreme event, because it provides timely finance that improves financial liquidity shortly after disaster. Just to give you an example, after the earthquake in Haiti in 2010, the funding by CRIF, which was already mentioned here today, was the first form of liquidity to be received. It came 2 weeks after the disaster. The second point, insurance can play a promotive role. And here again, the problem is that poor households often try to avoid risks in order to limit their exposure. And therefore they go with activities that have lower risk, but often also have lower returns. And now the role of insurance is that it can help and lessen the financial repercussions of volatility, which means it provides a security. When a farmer knows that he has insurance and that a payout comes in case a disaster happens, this can unlock opportunities for this farmer because he has this security. And unlocking opportunities can mean incentivizing people to take positive risks and invest in higher return activities, which might be risky activities, but they have higher returns. A really nice example for that is the index-based livestock insurance in Kenya and Ethiopia. And there we see that households with insurance coverage increased investments in livestock veterinary and vaccination services. And the project team observed that these changes to production strategies led to an increase in milk productivity of livestock and the total value of milk produced. So a really positive outcome by the people insured. Or we also see that with the R4 initiative in Ethiopia, insured farmers increased their grain reserve as well as the numbers of oxen that they own compared to farmers that were not insured. The fourth role, insurance can have a catalytic role for other elements that are important in the cycle of risk management. And one element that insurance can catalyze here is particularly risk assessment. And we all know that a proper risk assessment is essential to raise the awareness and build anticipatory capacity for potential impacts of weather events. But those assessments are often not conducted in developing countries. But for insurance, risk assessment is a vital part as it's the precondition for calculating the premiums for policyholders. So every insurance product needs a risk assessment in the design phase. And so accordingly, insurance products can facilitate regional and international data analysis and can be a catalyst for risk assessment. The last point on that slide, which I would like to highlight, is that insurance can also spur transformation. That's the first, that's the last part. And how does it do that? Insurance spurs transformation by helping countries to reshape the risks, the way risks are managed within the countries. It does so by encouraging risk reduction activities, catalyzing risk assessment, and driving just a more structured decision-making process around ex-ante risk management. And so in other words, insurance can motivate people to think ahead and plan before a disaster hits. A really nice example for that is the African risk capacity, and the ARC is requesting contingency plans as a criteria for insurance. Like countries have to have their contingency plans ready before the insurance contract is signed, and so this provides incentives for governments to invest in their emergency planning and response capacities before a disaster happens. And when we talked to people from ARC, they told us that this contributed to changing the process in countries of disaster relief programs from crisis management to disaster management. And the next slide. This all sounds really, really good, but what we have to mention here, and what I want to highlight here, that all those successes, it wasn't insurance alone that did that. It was insurance that was integrated in a comprehensive process of risk management. And on this slide, you see the different steps of risk management, and you see that insurance is only one step in that process. And so we want to highlight here, insurance should be closely linked with an ex-ante risk management that places priority on preventing losses. And so prior to transferring those risks, you need to have measures towards risk identification and assessment, risk prevention and reduction, and then preparation for responding to future events. And then insurance can subsequently play a role as a financial instrument to address the residual risks that remains after all those other measures have been taken. The R4 initiative, again, I already mentioned it, is a really nice example for that, to see how to integrate insurance in such a concept, because it right now reaches more than 37,000 farmers with 4 integrated risk management strategies, which is risk transfer on the one hand, but also risk reduction, prudent risk taking, and risk reserves. And so within R4, we have the weather index insurance against drought, but it's not the only element. Farmers can also pay their insurance in cash or through work for insurance. They can work for it. And if they take the second option, R4 engages them in community risk reduction activities. And all this is complemented with a savings element, individual or group savings, which enables farmer to build a financial base. That's enough for the first point. I would like to come to the second question that I introduced at the beginning, which is how can we make sure that with the climate risk insurance instruments, we actually reach the segment of the population? And we're talking here about people that often have below $3 a day. And so we looked at those 18 existing schemes and analyzed how they targeted and reached the poor. And we looked into success factors and challenges. And essentially, we ended up with a bunch of lessons learned from those schemes. And from those lessons learned, we derived 7 Propoor principles for climate risk insurance. And those principles, they can be used for multiple purposes. They can guide how new insurance schemes that benefit the poor and vulnerable are designed. They can also help identifying insurance schemes to be supported by international initiatives, such as the Insure Resilience Initiative. And I would like to briefly introduce all of those principles. The first one, which is to have comprehensive and needs-based solutions. I think I talked a lot about that in my last point. Solutions to protect the poor and vulnerable must be tailored into local needs and conditions, and it is imperative to embed insurance into comprehensive risk management that improves resilience. Second point, client value. We saw that providing reliable coverage that is valuable to the insured is crucial for the take-up of insurance products. And that in practical terms mean you have to ensure that critical risks for those people are not underinsured. You have to actively reduce the basis risk for index products. And you can bundle insurance products when appropriate with other services that might add value for the people who you insure. The third point, and I think we'll hear more about that one later, is affordability. And we see that measures to increase the affordability for poor and vulnerable people are paramount to the success of an insurance scheme, and also very important to satisfy equity concerns formulated in that manner. And we have 2 recommendations here. And the first one is it is important when you target this segment of the population to provide smart support. And we think smart support is characterized by being reliable, it is flexible, and it is long-term, and it distorts incentives as little as possible and makes the client aware of the true risk cost. And on the other hand, actors should also strive to indirectly reduce the premiums by, for example, investing in risk reduction measures and an enabling environment. We'll hear more about that later. But reducing reducing the premium indirectly will create long-term co-benefits for building of a comprehensive disaster risk management framework. The fourth point, accessibility. We saw in those 18 schemes that efficient and cost-effective delivery channels that are aligned with the local context are key for reaching scales for those products. What worked in those 18 case studies was to build on natural aggregators such as associations or cooperative or mutuals, which already have established successfully delivery channels on the ground, or to utilize social protection programs to implement large-scale development of insurance for the poor and vulnerable. The fifth point, participation. We saw that successful insurance schemes are based on inclusive, meaningful, and accountable involvement of potential beneficiaries and other relevant local level stakeholders. And they all should be involved in the design, implementation, and review of those insurance products, all those steps. And this creates trust and provides the basis for local ownership and political buy-in, which is essential for those products. In practice, this means to actively support and build partnerships that allow for inclusive involvement of the poor and vulnerable. It also means to ensure that the design and implementation process of the schemes is transparent and to have an effective monitoring and evaluation framework. before I close, 2 more points. The 6th is sustainability, where it is important to provide a long-term perspective on planning and financing, as setting up insurance schemes is a multi-year effort. It is not finished after 5 years. And then it is important to incentivize risk reduction and prevention through the design of the insurance scheme. That is possible, for example, by bringing it into the premium design. And then you also have to ensure that your insurance scheme does not incentivize practices that are not environmentally sustainable. Last but not least, the enabling environment, where we say it is vital to actively build an enabling environment that accommodates and fosters Propoor insurance solutions. And there it is important to support capacity building, to improve financial and insurance literacy and risk awareness of the insured, but also of the local insurers, distribution channels, and governments. It is also important to strengthen regulatory and legal frameworks and to promote strong and long-term partnerships, and particularly public-private sector partnerships. We see that a lot of insurance schemes have that as success factor. And the last one is to invest in freely accessible data and technologies, which is crucial for uptake, distribution, and payout of insurance product. And so I wanted, like, my last words were to say that we recommend InsurResilience to use those principles as a normative framework and minimum benchmark for monitoring of the initiative. But I heard that this is already in the concept, which is fantastic. And so I can just say you'll find the study online, all the results, and a lot of examples in there on our MCII website. Take a look at it, and thanks for listening.
Thank you, Laura. That was a mouthful. Very good. Very insightful. So we learned a lot about the preconditions that need to be fulfilled to effectively reach out with insurance to poor and vulnerable people. But now I would like to transition, which is Thomas Losta. He's the chairman of the Munich Re Foundation and also a member of the MCII Executive Board. In his work at the foundation, he deals with all kinds of global challenges related to environmental and climate change, such as water as a resource, water as a resource and risk factor, population growth, and disaster prevention. Thomas is an insurance expert for different products, from macro-scale disaster insurance down to microinsurance, and he has 16 years of experience at Munich Re's Geoscience Research Group. And Thomas, I would welcome if you would please reflect on what the principles mean from the views of the private sector.
Thank you, Michael, and thank you for this rich talk. So I just once again want to highlight that this is really a book which also has all the checklists, what stands behind each and every point, and what Laura told us. You find it here, you download it tonight, and you read it overnight because it's just a great brochure. So I was for 16 years in the for-profit business. Now since 12 years I'm in the non-profit business, and I have 2 major issues. One is, why insurance? Why is it so important? What are the benefits? I know that many of you don't even trust your own insurance agent. So I will convince you that insurance is one of the great solutions we have. Not a silver bullet for everything, but one key element, and it can be a crucial element in adaptation projects. And the second is, we cannot do it with political will or with declarations. We need the private sector. So my second point will be, how can we engage the private sector, and what are the success factors to make insurance successful for a better world and a climate change resilient world? So 2 points here. So many of the points you see on this slide, but in my words, just to further explain the benefits of insurance. So usually some of you might think insurance is a cash in, cash out mechanism. I pay premiums, I'm cheated or not, and in case of a claim, I get money. And the issue is, does the government subsidize premiums? Does the insurance pay? And what I want to tell you is that insurance is not a cash in, cash out mechanism. It's a process with so many proving quality of risk awareness, and you see them listed here. In some countries, you would not be able to act, or economists would not be able to act if there was no insurance for them. It enables activity, like in my private life, car insurance helps me to drive a car. As Laura said, quick financial compensation in the case of Griff, after 14 days, the governments get money and they can rebuild structures. The risk gets transparent because insurers won't insure without knowing risk exactly. And it is very important that only through insurance you get any detail of risk transparency, because the premium is a price tag of the risk, and this is clearly communicated. And as said, insurance is a process involving a lot of risk awareness. All these nice projects which Laura and her team investigated in the study, like the Harita R4 or others, this is processes with farmers, ongoing talks and debates, teaching and capacity building, because if they don't understand what insurance is, they won't buy in. So insurance is not only the money going over desks, but it's also a huge program creating a lot of awareness with people at risk and with institutions and mutuals and you name it. It includes risk prevention, because usually, and Laura made the point with the ARC, with the African risk capacity, a country can only be a part if it has a contingency plan, if it has a clear strategy how to cope with a major drought. Otherwise, a country cannot benefit from the insurance scheme. And of course, if a government is forced to put up a strategy, a contingency strategy, this is improving the risk situation and the relief of the country a lot when it comes to a drought. Finally, we are always arguing we have no data in the middle of nowhere, in the Horn of Africa, in parts of Latin America. If we include insurance in our political and adaptation strategy, we get a lot of data, and you see it on the right-hand side, there is a wheel of insurance. If there is no interest in a country, you have no research, you have no data, you cannot grow insurance markets. But if there is data, or if there is interest, you get a lot of research, you get more data, markets are growing, interest is growing, research is growing. So insurance is more or less a motor for creating data and knowledge and awareness. And you could take it that this wheel on the right-hand side is turning very fast in the US, in Germany, in the EU, because the mechanism is fully working, and in poor countries such as poor countries in Africa and other continents, we need to get this wheel turning in order to get all the points which are listed on the left-hand side of this slide. Next, please. Now, two examples, because we talk about insurance, but what is it? Here you see a policy, insurance policy from Tanzania, from a smallholder farmer mutual, and this says that 4 people of the family of Seaman Monchi are insured, and the cost for 1 year for a full health cover for 4 people is 20 euro. 10 euro the farmer has to share himself, and 10 euro are paid by a Dutch foundation. And if the farmer, if the head of family breaks his leg, if he gets any kind of disease, there's a treatment. But again, how could you roll out such an insurance plan, such a cheap scheme in a country such as Tanzania? What you need, and this is the next slide, you need at first infrastructure, because you cannot sell health insurance without having a hospital. So the insurance scheme, the so-called health plan in this area south of Kilimanjaro, led to installing a tiny hospital in the middle of nowhere with a clean room for surgery, and people who buy this insurance can benefit a lot. And what is the main risk people take? It's giving birth. Usually women give birth in their huts, and the mobile phone serving as light to support. And here they get a really healthy, a good birth in this. And the insurance is not only the mechanism of getting 20 euro for an insurance scheme, but also for creating infrastructure. And now let's come to our family business and the Munich Climate Insurance Initiative. Hurricane Thomas devastated larger parts of the Windward Island in the Caribbean, killing hundreds of people and destroying a huge share of GDP. And you see some impressions here. So that is why the MCII invented or introduced a so-called livelihood protection policy. Next slide, please. And you see on the left-hand side how it's marketed. It's addressing the low-income sector, but people who have money. And on the right-hand side, you see a teacher who bought a policy saving her for a large hurricane, which is including high wind or heavy precipitation. For the value of 4 meals only, she gets a policy, and she can buy up to 10 policies. And if there is high winds, as we saw it a few years ago, 100 years event, if there is high rain, she's reimbursed and she can get a few hundred up to a few $1,000 to repair her home, to a fisher to repair his boat, and so on and so forth. So this insurance is helping her a lot, and it's affordable. Laura made the point about affordability because she just need to save 4 meals, and then she has her first policy. And so you see it's affordable, and it's helping her and other active poor in the tourism industry or in the farming or in the agriculture or fisheries, as you see. So it's affordable and it's helping. So next one, what we must be aware is this insurance also in the context of climate change adaptation can be very, very complex. Of course, life insurance is simple because you know how many people die in an area over time. But once it comes to crop insurance, this is a very complex thing. And we should not be blind on that eye if we want to have good insurance schemes providing food security. It's a lot of work and it's a lot of brain which has to go into the solution. So insurance is not a silver bullet, but of course, as said, it can help young farmers, for example, after a huge flood to get back to their feet. Next one. So what is needed to engage the private sector? We have here so many side events about the private sector, which is seen to be one point of a future solution. And what the private sector needs is stable, trustful partners. They need to trust the people and to trust the government. So compliance is indicated in brackets. They need a framework, as Laura said in point 7 in her scheme. And insurers, they need volume. They need to spread the risk over an area, and they need long-term business. If it's only for one drought for next year, it's gambling. Drought, yes or no? So insurance schemes work if it's a 10 years, a 15 years plan, and then some years are good, and then there is this huge catastrophe, but the plan is going on, and the insurer is able to re-earn his payouts through premiums. So if we don't have this long-term engagement, the private sector will not take a bite. And finally, delivery mechanisms, clear structures, clarity is, of course, a key that private sector insurance would get involved, and these are the key prerequisites to have them. Next one. The people, and Laura said it, point number 1, they need to define their needs and their risks. And as said, this is a process, and this gives so much transparency and capacity building with people. Otherwise, if they don't have their needs covered, they won't take it. And also they need to understand insurance principles. And the key point here is they are used to savings. The money is in their drawer, and they use it in case of an accident or a shock. But they need to understand that the premium is gone. But once a shock strikes, they get a huge amount of money for getting back to their feet again. And they need to understand their insurance agreement, as all of you need to understand your insurance agreement you have with your insurance broker. Last but not least, governments, donors, and NGOs understand the principles. They need not create insurance solutions at their desk in Munich or in The Hague or you name it. They need to create solutions based on the needs. And for governments, it's extremely important to have a sustainable will for ex ante versus ex post. So tell a finance minister he needs to give you money every year. The money might be gone. For the case, there might be a weather extreme. Very hard to understand, but otherwise it won't work. And as said, we need the long-term engagement also from governments and from NGOs. So let's go to the last slide. And I put it just to be very brief. This you can note down on your notebook. We need the 3 T's. One is insurance technique, which might be complex, but together we can put up schemes as MCII is proving again and again to help the poor. And in the study, you will find many very good schemes such as ARC, such as GRIF, as mentioned, and our Harita in the Horn of Africa. No more word about long-term commitment, but a huge thank you to BMZ and to Frank and his team to piece of work to get insurance into the G7 summit in Elmau. And I know that the BMZ and Ingrid Hofen and others, please forward my sincere thanks for pushing so hard to get the insurance issue into the G7 outcome. And it's just great because it gives us now 4 time of thinking about insurance and solutions. And this is the time we need for the process, as I said. Finally, sustained will for ex ante and sustained dialogue. Insurance is not a broker rings at the door or at a farmer store in Ghana and says, hey, I have an insurance product. It's an ongoing sustained dialogue about risk and about awareness and about prevention. Laura made the point that farmers at the Horn of Africa now use better seeds. They are better prepared for a drought. And if we have these 4 bullets I have here, and if all partners buy in, we will see a better adapted world in due time, and insurance can prove what it is, one pillar in a framework of adaptation measures. Thank you.
Thanks, Thomas. Let me now transition over to Aaron Oxley, our last presenter. He's the Executive Director of Results UK and also a member of the MCII Executive Board. Results works to empower ordinary people to learn about international development issues with the aim of ending poverty. He has been working in international development for over a decade, primarily in microfinance, building the capacity of organizations in the developing world to provide the poor with access to financial services. So Aaron, from your civil society perspective, how do you assess these principles that Laura has just presented?
Thanks, Michael. So hi, everybody. You'll be gentle with me. This is my first COP. I'm not a climate person by background, a development person. And really here we see the intersection of something where we have this big movement around climate intersecting with something very much focused on some of the poorest people in the world. And for that, I would really just like to start out by commending Frank and his team again, and indeed the whole of the G7 for committing to ensure resilience. Insurance by up to 400 million people over the space of a 5-year period from 2015 to 20. And should we pull that off as an international community, that's going to be probably the fastest extension of insurance coverage of any kind in all of human history. And it's going to be targeted at the poorest and most vulnerable amongst us. So that is a really bold ambition, and really, really pleased to be supporting that through the many different channels. And we need that. I mean, we've heard it already from many of the other speakers. The people that are most likely to suffer catastrophic losses, be killed, have their livelihoods destroyed by climate change and extreme weather events are the poorest and most vulnerable. And really what we're seeing with the rollout of climate risk insurance is some quite dramatic impacts. Africa risk capacity has been mentioned many times. A 1 to 4 improvement in terms of how much it costs. A 400% decrease in how much it costs to respond to a disaster, because you're getting disaster finance up front in weeks rather than relying on handing around the hat to donors and charity appeals and so on, with all those horrible images on our television, which come months and months later. So it's not only the right thing to be doing, it's also very, very smart. It saves us all a lot of money in responding to climate-related disasters much more rapidly. And we've also already heard from some of the other speakers about what are some of the other positive externalities about looking at insurance as a mechanism for helping us cope with loss and damage. And there we're looking at the building up of the infrastructure, the attention that's paid on the risk management, the actually focusing down on the details, and in many cases pricing this stuff up and seeing if you do these activities, what happens to the price. That's really important at the macro level. But when you look at the person, the individual family, the effects can be truly, truly tremendous. I think one of the things that really struck me about these Propoor principles, and I do recommend you read them in detail, they're really quite excellent, is that this is not the only set of Propoor principles for climate risk insurance that are out there. Results UK has some. We published ours a little while ago. BOND, the UK apex body for international development in the UK that encompasses all of the big agencies in the UK, also has a set of Propoor principles around climate risk insurance. And one of the really interesting things about these various Propoor principles is that they're all very, very similar. I certainly think they're not competing. They're not competing. There's so many of the core things that make them up are the same, which indicates to me that we all seem to be on the right track in that regard. I mean, I could spend a long time talking through each of the 7 principles that have been put forward in the MCII report and explained by Laura, but I won't do that. But there are some which are, of course, my favorite, but they are all good. I think one of the key things we've heard over and over that I would like to re-stress to this audience is, that insurance is absolutely not a silver bullet. I come from the microfinance sector, if you go back far enough, where we had microcredit and micro savings, and these were sold by the practitioners as a magic bullet to end poverty. And I think we're all very, very cognizant that turned out not to be the case, and that we do not want to make the mistake with the third financial service that we want to provide to poor people. This is not going to be a magic bullet for ending poverty. It's certainly not going to be a magic bullet for solving the challenges of extreme weather that's being driven by climate change. But it is going to be an absolutely essential plank in terms of making sure that we can respond to the challenges. And in fact, the evidence that comes through very strongly through this report from MCII is very much that it's not only necessary, it actually works even better when you're tying it into social protection programs, farm extension work, linking to other services is hugely, hugely important. I think I'm pleased to hear that Insure Resilience is taking these recommendations very seriously and building it into its work. As a civil society person, I would really push for everybody that's interested in doing climate risk insurance to incorporate this into this work. It would be great if the Warsaw International Mechanism, for example, could try and establish these or similar principles as the gold standard for what we will hold ourselves accountable to deliver as an international community for the most vulnerable people in the world. So really, for those of you that are in those conversations, that would be really powerful. I think part of the challenge around all of this, around climate risk insurance, is where is the financing going to come forward to pay for everything? And I think there's a lot of very interesting conversations to be had about that. If we are going to pay for this out of adaptation financing, for example, we're way behind on where we are in that. So really, I think there's something to be said for exploring how else we can finance this. And again, I come back to that 1 in 4 improvement in how much it costs to respond to disasters. We can spend what we're spending now and spend it far, far, far more effectively as just a starting point before we start to talk about increases or decreases in financing. And then lastly, I think it's been great to hear Thomas talk about the role of the private sector in all of this. And I think we need to be very careful and also very supportive of the private sector's involvement here, because I will be the first to say that it's absolutely essential that we have the private sector involved in the development of climate risk insurance. We will not be able to do it without the private sector. The expertise is there, and the ability to drive that wheel that Thomas put forward, I think, is a very, very powerful way of envisaging how this can all work. And I think there's plenty of room. The figure between 1980 and 2015, only 2% of catastrophic losses were covered by insurance in the global south. There's huge scope there for insurance markets to be growing immensely related to climate risk insurance. But one thing, and this is where it comes back to one of my key favorite recommendations from the report, is a recommendation 3 on affordability, and looking at what this means for the poor. Back many years ago now, I was involved with an organization called MicroInsured, looking at producing some typhoon insurance for smallholder farmers in the Philippines. And one of the things we discovered, unsurprisingly, after looking at 50 years of meteorological and agricultural data from the Philippines, was that if you live in a certain part of the Philippines, you lose 100% of your crop every other year. There's no way that any kind of commercial for-profit product is going to be appropriate for that community unless it's heavily cross-subsidized in some way by some other actor. And indeed, if you look through this report, and as you examine some of these things, you'll see that many of these examples do have some kind of very smart premium subsidy. And so, you know, I think one of the big challenges that we have as a community is how do we balance up the absolute need to grow these markets and to make this into a sustainable business for everybody involved, with the ability to reach out in a non-market distorting way to these vulnerable people with either social protection linked or some kind of other support, so that we make sure that we reach them and they don't get left behind yet again, how the poorest are left behind by just about everything else that we do in development. So I guess in summary, I think we have, it is such an exciting time to be having these conversations. We have a colossal opportunity in front of us to be able to extend this help to literally hundreds of millions of people, to help break that cycle of poverty where people are continually smashed back into poverty by extreme weather events. Give them the tools they need that they can build up their household assets, build up a country's economy. Very, very powerful. And just really pleased that we're having this conversation about how exactly we're going to do this. Thanks.
Thanks a lot, Aaron. That was very interesting. So now I think we still got 30 minutes to go, and I would like to take the opportunity now to open the discussion to the audience, so that you also get the chance to bounce off your most important questions off of our experts here on the panel. So can we organize the microphone, and then where's the... Do we have a microphone? Oh yeah, okay. No hurries, it's fine. Sabine.
Thank you very much. So my name is Sabine Meninga, and I work for Bread for the World, which is a German aid organization. And I couldn't agree more to everything that was said on the panel. And we also believe that climate risk insurance, and especially the initiative Insure Resilience, was like a step forward to address a concrete example of loss and damage, and also financing loss and damage. So before I start now repeating everything what I really like about the scheme, I come to one concrete example. Last month, I visited the island state Tuvalu in the South Pacific, and they were very, very keen to be part of the Insure Resilience. This island state has like 11,000 inhabitants, and you can imagine for them it was not possible to pay the annual premium. And they are like the poorest and the smallest country, most hit by climate change. And I think that is like a very bad example that they cannot afford to be part of this initiative. So I wonder how the G7, the G20 or the German government can help in the premium support of the island state of Tuvalu.
I would go and gather one or two questions, and then have the gentleman and lady decide who we go with, please. Yeah.
Hi there, Simon Bradshaw from Oxfam. Thank you, that was extremely useful information there. One question I had is, can you comment at all on the Malawi experience with the African risk capacity? I don't know if that's one of the cases that's looked at in the report, but okay, you're obviously nodding, it's one familiar with. I mean, my understanding they're somewhat limited, but obviously there was significant losses due to drought and then minimal, if any, payout from the facility. So knowing a bit more about what happened there, what the lessons were, and how it can be avoided again. And just to continue on the discussion about premiums and financing, which we touched on at the end, and the equity considerations around that. I mean, obviously one point to make is that if premiums are being paid by countries and communities, then that's shifting some of the costs of loss and damage from climate change onto those who've contributed the least. And how do we deal with that? Can there be ways of raising finance for insurance based on polluter pays principles? Or I'm not sure, just any further elaboration on that question would be great. Thank you.
We try to address now the first question by Frank Fassmetz and then Thomas Losta.
Okay, thank you for the question. I was sure this question would come, and it's a key issue which is on the table, and I can only say that I don't have the perfect answer for it. We need to move forward, learning together to strike the balance between the equity and justice dimension and the sustainability dimension. If we want to promote insurance schemes, and Thomas Losta pointed to that, we need to have a long-term focus. Otherwise, we won't provide a service which helps people. So in the issue on how to address the question of affordability, we can start off with two elements. One is the international community can contribute to establish the capital base for insurance mechanism, and that's what we're doing. This is one part of the sustainability dimension, and the other part is the premium side. And again, we can work with countries, with individuals on providing support to premiums as a start off to learn together on how insurance work. But at the end of the day, insurance as a mechanism can only function if the beneficiary of the insurance is able to afford the premium in the long term. And we are working with the different schemes through different modalities on how to find that balance. It's clear that at the stage we are today, we look on how to start learning together on how the insurance scheme works. There was reference made to the African risk capacity, and the start of African risk capacity currently has foreseen that countries pay a respective premium. We know that a lot of countries, to afford this premium, receive finance from international sources, and we are working with different entities also to ensure that there is finance for that purpose. I won't go into more detail. We'll have an announcement on a specific mechanism regarding to African risk capacity next week. But just to say that this is a joint learning exercise. But we should not forget sustainability at the long term is key, and it will only work if at the end of the day the beneficiary really can afford the payment. That's not the answer for Tuvalu right now. So Tuvalu, I think, is a case where we need to look on different approaches on how to support the country. I can only point to one dimension, and Ms. Meninga knows it quite well. The Green Climate Fund has provided an important program to support Tuvalu, which encompasses financing of twice the GDP of the country to work on risk prevention and economic development of the country. These are elements which need to come together with insurance schemes as well. Thank you.
Thomas.
Yeah, so for the Tuvalu issue, thank you for this. I mean, I would, for the time being, see the World Bank IFC closer to Tuvalu. They have a huge information system, PC-RAFI, and this is an information scheme for Pacific Islands, including also financial risk transfer component. And they paid in several areas after several events in the Pacific Islands. So I would link you to these guys and help you how Tuvalu can connect to this, which also includes information and insurance. Yeah. And also I would link you to other people relevant here. About the Malawi, yeah, this is a really bad story or a really teaching story because it's about an index, and the background for those who do not know, the African risk capacity insured Malawi, and Malawi is having had very, very sincere El Nino events, huge floods, huge droughts. The country suffered a lot, farming suffered a lot, agriculture suffered a lot. And finally, the ARC had a dispute with payouts because the payout was based on a so-called index, which is a certain meteorological value. Once it's reached, a payout is triggered. And to make a difficult story simple, this was based on humidity available for plants. And it rained, but it came out that the humidity which was needed for plants was not enough, and there was a huge argument between ARC, the government of Malawi, and also World Bank was included, and the argument was, if ARC does not pay out, this is so bad for reputation of ARC, and this will of course distract many participants. So as much as I know, in mid-September, there was a decision that ARC pays out, despite the fact that the index was not fully reached. And this is a big problem. We see, and I said agriculture is very difficult. I give another example for Ethiopia. There was a drought insurance based on the 3 most sincere droughts. And once there was one drought like this, 17 million farmers would benefit from insurance. It was very hot, it was very dry. Farmers lose their yield, they lose their cattle, but it was not one of the 3 most biggest droughts in 20 years. So this index point or the trigger was not triggered. And this is what I mean by it's very complex, and why I say everybody must understand the agreement. We must define simple triggers which everybody can understand, and not complex triggers like used in Malawi, which is a very difficult construction. But finally, as much as I know, there was an agreement that the country of Malawi benefits from the ARC agreement. Here we have an insurance paradoxon, because if you guys have a car insurance, you say, hopefully I never need it, because you know if you need your car insurance, you have an accident. This is not good for you. In a poor country, if you insure farmers and the finance minister contributes to premium, they want to see benefit the next year. They are asking for a huge disaster next year to get money back. And this is, of course, a paradoxon which we need to solve. And the solution is build simple trigger concepts, simple payout schemes, as I said in my presentation. And then if everybody understands what we talk about, we will have a big benefit from insurance.
If I may jump in on the Malawi case, because Germany is involved in the discussions, and two points I want to make. First, I would join Thomas Losta in saying that if we have an agreement on what is the trigger and judging on whether the trigger has been met to make a payout, I think everybody needs to adhere to this trigger. Otherwise, the mechanism will not work. The issue with Malawi was that the trigger was poorly designed, and Malawi, African risk capacity, both looked on the issue on how to, where were the mistakes and how to correct them. There are still discussions going on. It's not a final decision on what will be the way forward in this regard. Just to point out that it's necessary to be very careful in designing the trigger, that it really addresses the risk in the right way. And this is what has been the work which has been done the last 3 to 4 months to find a solution for but rather have triggers which function addressing the risk in the right way. And I'm confident that for Malawi, in this regard, we will have a positive solution.
Please, Aaron.
Yeah, just really briefly. I mean, again, coming back to the Propoor principles, you know, principle 1, comprehensive needs-based solutions, and principle 2, client value. If you dig into the details that are underneath there, they talk a lot about, you know, actually focusing down in on the people who are being protected and making products that explicitly are meeting their needs. And that comes down to things like simple triggers. You know, if you have complicated triggers, if you have complicated products, if you can't explain this to a farmer, then you have to explain later on to an angry farmer, to a desperate farmer, to a hungry farmer whose children are hungry, why their insurance has failed them. And so we do need to, as part of these principles and as part of building these good products, continually be pushing these things down to the people who are ultimately the sharp end of the process. They're going to be either benefiting or not benefiting from this.
Additional questions from the audience, please? You here in front.
Hi, nice to meet you. My name is Antonio Cherubini from WeatherTech, a German company which can enhance rainfalls. My question is, have you ever worked as a reinsurance with companies to reduce the risk? So it's a bit out of the box thinking. So what would happen if you could reduce the risk of having a drought or reduce the risk of having a wildfire?
The lady in front here.
Thank you. My name is Petra Chucker at University of Western Australia. I much appreciate your needs-based approach to insurance. Very nice. But what happens if people's needs, what people value, and what is at stake from climate change does not have an economic value? So what happens if what people need, require for their livelihoods, for their well-being, is social cohesion, sense of place, identity, and so on? So how do insurance mechanisms like your own or others deal with these dimensions, these needs, these values? And if they don't currently, how can you see that they will in the future? Thank you.
Shall we gather another? We had the gentleman in front here with the, yes. I go over there now.
Yeah, thank you very much for the presentation. My name is Lawrence Keguro from World Vision, Kenya. My question is with respect to pastoralists, whom we know they are most vulnerable when it comes to issues with drought. Any experiences with pastoralists, insurance for pastoralists, people who normally suffer when there is serious drought? Thank you.
Good then. Who wants to start? Thomas, okay.
The first question was whether the reinsurance industry is investing in initiatives reducing the risk. And what I tried to explain in my talk is that insurance alone is already a mechanism reducing risk, because, as I said, it's a dialogue with the insureds or with the people who wants to have insurance about their risk. It creates a lot of risk awareness, and further, within the treaty agreement, you include also paragraphs reducing the risk. One simple example, if you have a road being constructed in the agreement, it says you must remove all material above flood level, otherwise you're not insured. So this is really decreasing risk. So I would say insurance alone is a risk minimizing factor. Yeah. For the second, the needs, it's an important point. I mean, we once introduced a flood warning system in Mozambique, and we did a needs study, and we did a narrative study, and the people said, we want to have access to markets. We said, yes, I understand you want to sell your products. We want to have access to education. Our children walk for 10 miles every day. They need to be trained here. And we want to have access to health. My grandfather died and there was no hospital. And then I said, you have huge floods every second year. Oh yeah, we forgot we have the floods too, and people die. And so this is a good point. Insurance and parts of insurance, as said, can only carry a portion of the needs of the people. But again, in this case, the debate made transparent what the people really needed. And this is, of course, an issue for development cooperation and NGOs such as GIZ or DFID or you name it. Other people might contribute more. This is what I have here. And about ensuring pastoralists against drought, this would not be able out of the blue, but if there is, and Laura said it in point 7, if there is an enabling environment, be it NGOs active in these areas, there is a chance to create a structure. This kind of climate risk insurance mainly works if you have communities, societies, municipalities being prepared, if you have pre-structures where insurance can enter and open a dialogue and offer insurance. Insurance never works with people going to a country and saying, hey, listen, I have insurance for you. So the answer is yes or no. If you have an enabling environment and you find it in the study, the farmers can be insured. If you don't have it, I see many difficulties.
With regards to the question, do you hear me? Yes. With regards to the insurance, do insurance companies work on reducing risk? I just want to strengthen Thomas's points, and I think we mentioned it already. And in those 18 schemes that we looked at, there was one from India, and they have a mechanism that clearly links the premium to risk reduction activities. And if you reduce your risk through certain activities, your premium will be lowered, which is a great incentive. And then on the non-economic part that you mentioned, in this bigger report, we have a section about limits of insurance. And this is where I would cluster that under, because insurance does not work for all events. It works for extreme events, but it doesn't work for slow onset events. And it's a market mechanism which covers which is not working for non-economic losses, at least not from examples that I know. So I would classify that clearly that as a limit to insurance, which is not bad. We have to be aware of those limits and have to use other instruments that chip in here that address those losses that you mentioned.
Just very briefly on the issue of the limits of insurance. I think we all agree that insurance is not the silver bullet solving all issues, all problems. And of course, issues of health, education, productive base, issues which international development cooperation can help. Issues of social cohesion, identity are not that easily accessible for international cooperation. But I would like to make one point on insurance. If people are under the risk of suffering from extreme weather events, it will be much more difficult to address the social and economic development dimensions if they don't have insurance. If they have insurance, it's much easier because they have a safety net for that purpose. So it can help also for development, and it needs to be embedded in an appropriate comprehensive risk management and development approach.
Thank you. I think we have time for 2 more questions. We had more questions on this side, please. The man in the light shirt in the more middle section. And then the gentleman 2 rows behind him with the glasses, please.
Thank you. Robert Gibson, Hong Kong. The Green Climate Fund is supposed to, or the idea is it spends half its money on adaptation, and it's into paradigm shift, making new things happen. It's moving very slowly in terms of the number of projects and the amount of money it's committing. What would the panel's wish be in terms of what the Green Climate Fund might do to greatly accelerate the good things that insurance could bring to the poorer people in our world?
We don't have any other question?
Yeah, you can respond immediately, and then, yeah, we gathered the question first. Yeah, okay.
Thank you very much for your talk. My name is Daniel Hiddewan. I'm a PhD researcher at Imperial College London in climate change and renewable energy. I wanted to ask, considering that scientific knowledge in climate change is continually growing and developing, how well do these market mechanisms incorporate new understanding on the future projections of climate change? And does that kind of offer that package to their clients in particular?
So first a question from Hong Kong, yeah.
Yeah, the Green Climate Fund, as we all know, getting started and starting to do good things, but also very complex due to the composition and other issues. So what would I wish? I would wish that we would see a global insurance facility somewhere under the umbrella of, you name it, be it the UNFCCC or even the Green Climate Fund, and directing a portion of the money for insurance mechanisms. I mean, we are discussing the issue since a while. Who does facilitate insurance and who takes care and who will do it? But my wish would be that money of the Green Climate Fund, and there's a lot of money and more to come, should be partly dedicated to also insurance mechanisms, of course, not only, but also. And about science, current science always flows into the insurance solutions and markets. I mean, the company that founded my foundation has at least 30 scientists more or less every day looking into new findings. And the same is true for other big insurance and reinsurance companies such as Allianz or Swiss Re or others. And including science is not at all the issue. I would even say that insurance, since they have to pay, sometimes are ahead of regular university science. But now you beat me, I know.
Frank?
Just focusing on the question on the Green Climate Fund, and I'm sitting on the board of the Green Climate Fund. There's a decision that 50% of resources should go to adaptation, and of that, another 50% to the most vulnerable countries. So there's a strong focus on adaptation at the Green Climate Fund. I think there are several elements what the Green Climate Fund can do, and some instances already doing. The dimension of working on risk management, on early warning, on embedding adaptation in national development with a appropriate risk management approach are dimensions where the Green Climate Fund can do a lot. I think also the Green Climate Fund can work in capitalizing risk pooling schemes like the African Risk Capacity or others, depending on the interest of the respective entities to ask for support at the Green Climate Fund. And this, again, is something where national governments need to decide. Recipient countries which shall have and have the ownership on projects which are presented to the Green Climate Fund need to make the right decisions in this regard. And the fund then is up to respond to these requests.
Thank you. Aaron?
So what to do with the money? How do we spend it? So a couple of suggestions, echoing Thomas's call for, ultimately where we want to end up is to have some kind of global risk pool. I think, looking longer term, there's a reason why there are so few big reinsurance companies. It's because you need to be really big to do it properly. We're talking billions and billions of dollars under management to manage the size of your risk pool, because if you don't have a very, very big pot of money sitting there, you can't respond to a very big disaster. And if we're talking about insuring hundreds of millions, even billions of people that don't have insurance right now, we're going to need a very, very big risk pool. Now that money doesn't go away; it sits there for a rainy day. It's a capitalization thing, so it's not the same as ongoing supporting premiums. But what's really fascinating is when you start to dig into the details of how insurance works, is that when you're looking at the pricing on just African drought versus just typhoons in Southeast Asia, the price is relatively high. When you look at a risk pool that includes both of those things, the price goes down pretty quickly. And so really it's very true in insurance. And Thomas, you are an expert in this and can speak to it at a much higher level of detail than I can. But just the bigger the pool, the better. So ultimately, I don't think we want Africa risk capacity and Caribbean catastrophic reinsurance facility and so on. We want these things to be aggregating up at some kind of global level eventually, and how quickly that happens is kind of a question for us to think through. And then in terms of the green, what else can the Green Climate Fund do? I've written down here, integrate in very big letters and drawn a box around it. I mean, we've all said insurance doesn't stand by itself. It's not very good if all it does is its own little thing, its own little corner. The kind of programs that are being financed with donor money and with climate fund money, if they're thinking about how to integrate insurance mechanisms and insurance principles into how some of their programs and some of their work, or how to integrate other really cool disaster risk reduction activities, loss and damage management tools into somebody that comes forward with a great insurance idea, let's make sure that we're sticking all these things together at the design stage rather than having to stitch them back together afterwards.
Thank you, Aaron. Looking at the clock, I have time for one very, very quick question. If it's quick to answer, then this one over there. Yeah, please.
Yes, my name is Irving Mincer. I'm a professor at the Johns Hopkins University School of Advanced International Studies. One of the interesting successes of the last year has been the emergence of the Insurance Development Forum as a place where complex synoptic views of the challenges we face that Aaron was just referring to can be addressed. Could you give us a little update on where the Insurance Development Forum is now and what you expect it to be able to do over the next 12 months?
All right, 1 minute.
The Insurance Development Forum started with a lot of momentum because really key players, as you know, were putting it up. And right now, after this, they formed work groups and committees, and they invited also insurers and leading insurers and reinsurers to be parts of this. And very briefly, I would say they are still in a stage of sorting out how to deal with the issue. And it's taking time if you want to get all partners, all stakeholders in. But for the time being, there is not a big step that I could tell you that has been achieved by now. But talking about the Green Climate Fund, there we also know how long things may take, yeah. And the insurance development just started, so give them a while, and you might see very good results.
Just a very short complementary point to that. The Insurance Development Forum is from the insurance industry. Governments are in dialogue with the insurance industry on what is most urgent to do next. And we have an agreement, an understanding that it will be important to provide support for developing new insurance schemes. And we have discussions with the insurance industry on the best way forward on how to develop these new insurance schemes, what would be the role of governments, what would be the role of the insurance industry, and how to engage jointly in this element. Just as a flavor, but as Thomas pointed out, this needs some time to develop, but there are productive discussions on that.
Afraid that we have reached our limit. I hope the session was informative to you, and please engage in further conversations when we have left the room. Thank you for your attention, and thanks for attending our side event. Just copying those. Oh, yeah,